Hello, everybody. I am Dr. Ross DePinto. I am one of your D366 course instructors, and in today's session, we are going to be conducting a review of the statement of cash flows. For this session, we'll explain the purpose of the statement of cash flows, discuss its structure and some analytical insights it presents. We'll review the order of cash flow activities, explain the impact of balance sheet changes on cash flow, review cash flow mechanics and reporting standards, explain the cash flow calculation methods that we apply. We'll present worked examples of calculating cash flow from operations, which is CFO, cash flow from investing, which is CFI, and cash flow from financing, which is CFF. We'll review how we reconcile the cash flow components. We'll review the benefits of cash flow statement analysis and provide sample analysis questions that you can use to evaluate the different sections of the cash flow statement. And then we're also going to provide you with some OA preparation questions that are reflective review questions to make sure you're tracking on the primary concepts and calculations related to your statement of cash flows, and then present a summary and key takeaways from the session. So let's talk about the purpose of the statement of cash flows. It helps users understand how a firm generates and uses cash through its core activities. It complements the income statement because it focuses on actual cash movements, not just the accounting profits that the company records. And so it provides a much clearer picture of the firm's liquidity, its financial health, and its ability to meet its obligations and invest its growth. The cash flow statement is divided into three primary sections: cash flow from operations, cash flow from investing, and cash flow from financing. So let's talk about each section. So the cash flow from operating activities section shows us how the firm generates cash from its core business operations: receipts from customers, payments to suppliers. It focuses on the items that are coming in from the income statement, like net income and the add back of depreciation expenses. And then it takes into account changes in working capital accounts, like accounts receivable, accounts payable. Our cash flow from investing activities shows us the cash that the firm uses to reinvest in the firm into its asset base. And we're talking about long-term assets like equipment, investments, land, buildings, etc. And then lastly, our cash flow from financing activities shows us the cash that the firm generates through borrowing, the accumulation of debt, the issuing of equity shares of stock, or when it repays debts or buys back shares of stock. It also takes into account the payment of dividends to shareholders. So it's going to offer us some insight that doesn't show up on the income statement or balance sheet, because it's actually showing us how cash is moving through the organization based on timing and management discretion. It also helps analysts detect earnings quality and potential red flags in financial reporting. For example, one of those red flags is if they see in the cash flow from operations that a lot of the cash generated is from non-cash add-backs like depreciation and amortization expenses. So if a good portion of your cash flow from operations is coming from that, it could be a red flag that the actual earnings the firm is generating are deteriorating. So our cash flow activity typically follows the natural flow of business activities. First, cash is generated from the firm's operations. Then it determines, okay, how are we going to reinvest in the firm in long-term assets to fund the growth of the firm and support it. And then we take a look at how we're going to manage shortfalls in capital by raising capital from external sources through debt or equity. And if you remember back from some of your prior courses, there was the discretionary financing needed calculation. I believe that's in D076. Well, that's part of what that cash flow from financing tells us, is how much more in discretionary financing the firm has received to generate the shortfall that might come from funding their assets. Now, the other thing to keep in mind is that when firms are in startup, they're typically not generating a great deal of revenue from operations. So the order in which cash flow occurs is going to reverse. They're going to begin with financing, either from getting loans or from equity financing. Then they'll invest in the assets that they will use to generate operating cash flows. So this slide is something you're definitely going to want to have as a flashcard as you're navigating the course, because changes in your balance sheet accounts have significant impacts on cash and cash flow. And this little graphic table shows you how changes in each section of balance sheet accounts impact cash. So let's talk about assets first. So for assets, there is an inverse relationship between changes in those account balances and what happens to cash. So when an asset increases in value, then cash decreases in value. An example of that would be if the firm purchased inventory. Well, inventory is going to go up in value on the balance sheet. However, you've got to pay for that inventory somehow, so cash will decrease. Okay, on the opposite end of that, when an asset decreases in value, then cash increases. So let's talk about that inventory account again. If we see the inventory account has decreased in value, well, that means we have sold that inventory, and it takes the form of cost of goods sold, which means we've relieved that inventory from our stock, and we've received cash from the customer for it. So the decrease in that asset account has generated cash for the firm. On the other side of the balance sheet, we have direct relationships between account balance changes and the impact on cash. So when a liability account increases in value, then cash also increases. An example, if the firm were to issue bonds, well, that's going to generate cash for the firm when they sell the bonds. Cash is going to increase. On the other side of that, when a liability decreases in value, then cash decreases. Let's talk about those same bonds. When the bonds mature, we have to pay the investors the face value of the bonds. It's a legal obligation. So when that payout occurs, okay, the liability is going to decrease on the balance sheet because we no longer have that as a source of debt. We're paying off our bonds. But our cash is going to decrease too because we have to make that balloon payment in cash out to the investors to pay out their face values. Okay, and then lastly, equity is also going to be a direct relationship. When equity accounts increase in value, then cash is going to increase in value. Perfect example. One of our main equity accounts we look at is retained earnings. Well, a primary feeder of retained earnings is net income. So when our net income increases that retained earnings account, well, cash increases. Okay? When that equity account decreases in value, then cash decreases. So one of the things we may have to do with our net income is pay out dividends to shareholders. Well, that comes right out of that retained earnings account. So that is going to decrease our cash. Okay, the question has come up. The asset relationship. I'm a bit confused still. Can you explain that one more time? Okay, so when an asset increases in value, cash is going to decrease. Okay, so I used inventory as an example. Let's talk about long-term assets. Let's say we buy a building for our company. Okay, on our balance sheet, our long-term assets, plant, property, and equipment, that's going to increase in value. Because we've bought a building, we have a new asset, but you have to pay for that asset, and that requires a cash outlay. So even though the asset increases in value, cash is going to decrease. Let me use a personal finance example. So suppose I am out one Saturday morning and I drive past a yard sale, okay? And I see that they have a Peloton bike on sale for $200, okay? I stop. Okay, I want to buy that Peloton bike. So what happens is, okay, I hand the homeowner $200. Well, now I have this Peloton bike. It's an asset. My balance sheet, my personal balance sheet. Now I have this asset worth $200. But my cash has gone down $200 because I had to pay the homeowner to buy that asset. Cash is going to decrease even though my personal assets had increased. Does that make sense to everybody? And that's a tricky relationship to understand because intuitively it sounds like, oh, well, assets are increasing, cash is increasing. Well, that's not the case because just think about your personal finance. Everything you buy costs you money. Think about our basic balance sheet equation. Assets equals liabilities plus equity. It means every asset personally that we hold or that a firm holds has been funded through a combination of debt or equity. Let's say that person running the yard sale, they took they had Toast or Square, I think it's called. But anyways, let's say you paid for that Peloton bike with your credit card. Well, the asset still increases in value, but okay, your liability increases on your credit card, but your cash decreases because what's essentially happening is the credit card company is giving you $200 in cash. You immediately turn that around and it goes out the door to get that asset. And so we have to keep in mind any asset we procure is going to cost us cash. Cash is always going to decrease. Any other questions on these relationships before we move forward? Okay, good, because these relationships are going to be essential as we talk through our cash flow calculations. So when we are performing our statement of cash flow calculations, we typically are going to be using the indirect method to reconcile income with net cash changes. Meaning we're going to be making adjustments for non-cash items such as depreciation and amortization, and then for any working capital changes. Remember, our working capital accounts are all of our current asset and current liability accounts excluding cash. So that means any changes in inventory, any changes in accounts receivable, any changes in accounts payable. So our cash flow reconciliation follows a very simple formula. Our beginning cash plus our cash receipts, meaning anything that has been a cash inflow, like net income, minus our cash expenditures, which are cash outflows, things like purchasing inventory. That's ultimately going to result in our ending cash. And so we can simplify this as beginning cash plus or minus our net cash flow, which is basically the sum of all these cash inflows and outflows, is going to equal our ending cash. Okay, so cash and cash equivalents are going to be considered our cash accounts. And that means our cash equivalents are things like short-term treasury bills, which means it's less than a year, money market funds, anything that's defined by GAAP or the IFRS as a cash equivalent account. It means it's highly liquid. We can convert it to cash very quickly, not something like inventory. Inventory is not a liquid account. And we know that because our quick ratio, we have to subtract out inventory because it's not as liquid to serve as debt like cash and cash equivalents are. And then this cash flow is also going to disclose any foreign exchange impacts or adjustments that impact our cash balance. If you're dealing with any foreign currencies, they fluctuate. And sometimes when they fluctuate wildly, it's going to really show up in the actual value of foreign currencies. And you have to account for that because it doesn't have the same buying power if we're trading currencies globally. Okay, so there are many ways to perform cash flow calculations. You can just use simple equations, adding and subtracting things. But the method I'm going to show you today involves the cash inflow, cash outflow method. And in this particular methodology, we're always going to be placing our transactions into two categories, either a cash inflow or a cash outflow. So our cash inflows are increases in cash, and they're going to have a positive value assigned to them. Our cash outflows are going to represent decreases in cash, and will always have a negative value assigned to them. So as we're working through our cash flow statement, we're basically going to be looking at the income statement and the balance sheet for where the information is coming from. So on the income statement, revenue and income are going to be cash inflows. They'll have a positive value. Now, the only exception is going to be if we have returns. That's going to be a cash outflow or a negative value. And I'll give you an example. Any retailer, well, if you go into Target, there's a returns booth right as you enter the door typically. Well, originally, those were revenues generated by Target. But let's say someone doesn't like the resolution on a big screen TV they bought there, and they return it. Well, that's going to be part of revenue, but it's going to be a contra account. It's going to be a cash outflow, a negative value, because the person has returned that asset to them. And what do we say happens if an asset increases in value? It decreases cash. So that television goes back into inventory. That's going to be an exception. Now, our expenses are going to be cash outflows or negative values. The only exception is going to be our depreciation and amortization. Those are non-cash expenses. So it's going to represent a cash inflow to us. Now let's talk about that briefly. So depreciation and amortization are going to be non-cash accounts because even though they reduce our taxable income, money never changes hands for those depreciation and amortization expenses. They just represent the wear, tear, and use of our assets because they're needed to operate our business. And so what happens is to accurately reflect cash, we have to add them back in our cash flow from operations. The question is warranties exercised. It depends where those warranties are going to show up. If it's a long-term liability, it's going to show up someplace else. But as far as cash flow, warranties exercised, okay, if the person pays us for the warranty in advance, okay, that's a cash inflow. If it's exercised, then it's a cash outflow. It means they used it, right? It means it's no longer cash that we hold. But let's say someone pays $1,000 for a warranty service for the year, right? Then they call, their washing machine broke down. We send out a service person to service that call. Well, that's going to be a cash outflow because we have to pay for the labor and the parts, right? So that's going to be a cash outflow on that warranty exercise because the consumer exercised their right to use the warranty, and we have taken cash out of our pocket to use to service that warranty. Okay, that covers our income statement accounts. Now, when we get to our balance sheet accounts, okay, for asset accounts, an increase in an asset account is going to be a cash outflow, a negative value. And we talked about some examples of that. We purchase inventory. We purchase a building. Anything we acquire in the form of an asset is going to cost us cash, and it's going to result in a negative value transaction. Okay. A decrease in the value of an asset is going to be a positive cash flow. Let's say we have a piece of undeveloped land and we sell it. Well, on our balance sheet, our land, plant, property, and equipment, that's going to go down in value. But what happened? We sold the parcel of land. That generated cash for us. That's a positive cash flow. Okay? And then for our liability and equity accounts, those are direct relationships. So an increase in an equity or liability account is a cash inflow, a positive value. Examples, I issue bonds. That is cash coming in from investors. I issue common stock. That's cash coming in from investors. Okay, decrease in value. Okay, I pay off a loan. That's going to decrease my cash. It decreases the liability, but it's money coming out of my pocket. I pay out dividends to shareholders under the equity section. Okay, that's going to be a cash outflow, a negative value. Any questions on those cash flows before we move forward? No additional questions? Okay, we'll move forward then. So here are some sample transactions of what you might see in each section of the balance sheet for cash inflows and cash outflows. And we won't go into all these in detail, but we've described some of them, but this is a good slide to just take a look at to have some perspective of what is going to happen in each section of the cash flow statement that will result in cash inflows or cash outflows. There is something I want to talk about in a little bit more detail that's not elaborated on in the text, and there's an important reason for it. And that is the whole notion of intangible assets. And the reason why I like to talk about it is because so many startups are related to the development of apps, mobile apps for phones, software like ChatGPT, things of that nature. Those are all intangible assets, and they've increased significantly as far as what firms produce these days. So I feel it's probably to our benefit to talk about them in a little bit more detail because they can be handled differently depending on how those intangible assets have been acquired. So an increase in intangible assets typically results in a cash outflow, but it depends on how the increase occurs. Okay, so let's talk about when cash would be impacted. So let's say a company spends cash to acquire or develop intangible assets. So like they purchase a patent, a trademark, they buy a software license, they buy a company that is developing an app, and bigger companies like Meta and Microsoft do this all the time. They buy smaller startup software companies. When they see an app they like, they want to bring it under their umbrella. So those transactions are going to appear as real cash outflows because cash has transacted, and it will show up in the cash flow from investing activities. So here's an example. Firm A buys a patent for a new product from Firm B. So the balance sheet changes that are going to happen. The patent or intangible asset increases in value, but cash is going to decrease in value. Okay, so the cash flow impact is going to be a cash outflow in our cash flow from investing because we've actually paid money for that intangible asset. Now, the second situation has no cash flow impact, and it's something we need to be aware of, especially if we are the startup company and we are developing an app. So let's say our company already owns an intangible asset that changes in value. Well, there's going to be no cash flow impact. So examples would be when there's internal development costs. And the second one is when it happens most. An app blows up in the market and then it's revaluated, meaning our lawyers and our auditors say, you know what, that app, it's now worth $10 million. It used to be $5 million. Well, the thing is, that revaluation, yes, it increases the value of our asset, but guess what? No cash movement has occurred. So it's not going to show up in the cash flow statement. It's only going to be a balance sheet effect. It's going to increase the value of that asset on the asset side of the balance sheet. But there's also going to be the same dollar value increase in the owner's equity section, but no cash is involved. And here is an example. Firm A owns a mobile app it developed that is revalued from $5 million to $10 million. Okay, so here's the balance sheet changes. That patent, that intangible asset, is going to increase in value. Now, a balance sheet has to balance. So if the asset side goes up $5 million, then that means the right side of the balance sheet has to go up by $5 million. Well, we didn't borrow any money, so it's not a liability. However, the equity section, meaning this is what the owners have invested in the firm. So it's going to be called a revaluation surplus, and it's a form of owner's equity. that's going to increase in value. And that's going to cause the balance sheet to remain in balance. The increase of the asset change is going to be increasing the same as the change in equity value. And so there's no cash flow impact, no cash is exchanged, and it's an accounting adjustment. Does that make sense to everybody? Because this is occurring more and more these days because of the proliferation of apps, and I thought it might be worth talking about. Okay. So now we'll go into our statement of cash flow formulas in more detail. So our cash flow from operations is computed by taking our net income, adding back depreciation expenses because they're non-cash, and then plus or minus changes in our working capital accounts, which are all of our current assets and all of our current liabilities excluding cash, and then any other add backs we might have. Our cash flow from investing, that's going to be our cash inflows from investing minus our cash outflows from investing. And then finally, our cash flow from financing is going to be any positive and negative changes in our long-term debt, any positive and negative changes to our stock issued, and then subtracting out the dividends we pay out to shareholders. So let's talk about each section and the calculation process. So one as I mentioned earlier, there's many ways to go around about calculating cash flows. I am going to show you this cash inflow, cash outflow method, because if you're not used to doing this, it makes things a lot more structured, a lot more organized, and there's less margin of error because you're categorizing things into cash inflows and cash outflows. So to perform our cash flow calculations, here is the generic structured process. The first thing we're going to do is state the formula, write it out. So this way we know what accounts we are looking for either on the income or balance sheet. Okay, on these problems, we're typically going to be given a list of account names and the transaction amounts. So the next step is to identify only the accounts that should be included in the transaction. So we're going to examine each account and determine, is this included or is it excluded? The next step is we organize our transactions into two columns, cash inflows and cash outflows. And then we record the value of each of those relevant transactions. Our cash inflows are all going to have positive dollar values. Our cash outflows are all going to have negative dollar values. So after we've processed all of the relevant transactions, we're just going to total up our cash inflows. That's going to result in a positive value. We're going to total up our cash outflows. That's going to result in a negative value. Then we calculate our net cash flows, which is the positive cash inflows plus the negative cash outflows. Now keep in mind, adding a negative value is the same operation as subtraction. I just like to keep it all one operation so that it's organized and we're not dealing with different signs. Following this process minimizes the probability of putting the wrong sign on a transaction when you're consolidating them. That's why I like it. So let's first talk through our cash flow from operations. Okay, so this is going to be any cash flows from our core business operations related to producing and delivering our goods and services. So it's going to include cash we receive from customers, customer purchases made on credit, that's our accounts receivable, payments we make for our raw materials and inventory, and things like vendor invoices, like if I have an account with, let's say, Staples for my office supplies because it's right down the street. Well, I typically call them up or place an online order. I get the materials pretty quickly, and then I get an invoice that's typically a 30-day payment cycle. It's net 30. This section uses the indirect method. We start with net income and then adjust for any non-cash items and accruals that make changes to our working capital accounts, like our accounts receivable, like our accounts payable. Okay, and any adjustments are going to include things like depreciation, gains and losses on sales, and changes in receivables and payables, such as our allowance for bad debt, because that's part of our accounts receivable accrual. So there's a couple of things that we need to take a look at as far as accounts that are going to link our income statement and balance sheet that are relevant to our cash flow from operations. So the first thing is our depreciation expenses. So the depreciation expenses are going to come in from our income statement, but then they're going to be added to the accumulated depreciation account on the asset side of the balance sheet. That's called a contra asset, because what it represents is the total historical depreciation that's accumulated on our assets. So basically, if we take the true original value of the assets, the gross PPE, and then we take out the accumulated depreciation, that tells us our net PPE, which is the book value of our assets. But those depreciation expenses, they come back to the left-hand side of the balance sheet because a balance sheet has to balance. Because we've taken those expenses out of our income statement. And that ultimately shows up on the right side of the balance sheet because our depreciation expenses have been taken out before we get net income. So the second account is our net income, which is going to get added from the income statement to the retained earnings account in the balance sheet. Any questions on that so far? No questions on that? Everybody still with me? Yeah, I'm going to be checking in with you folks regularly because this is some tricky stuff to get through. So I just like to make sure everybody's following, okay? Okay, so this next slide, this shows you where on the balance sheet you're going to see activities that are related to your cash flow from operations. So notice, it's just the top side of the balance sheet, just our current assets, which don't include cash, and then our current liabilities. Everything else is not applicable to our cash flow from operations. Typically, our cash flow from operations total should result in a positive number because the primary contributor to cash flow from operations is our net income, the income we have generated from our regular business operations. Exceptions would be if we have a loss in net income. Okay, this next slide, this shows you the cash flow from operations calculation process. So I've taken that general format and now I have applied it to cash flow from operations. So the first thing we're going to do is write out our formula. Okay. The next is identify all the relevant accounts to include in the calculation. In this case, we're going to look for our net income and depreciation expenses from the income statement. Then we're going to examine each balance sheet account transaction to determine, is it a current asset or a current liability? Those are the only balance sheet accounts that get included in this calculation. Then as we're going through, we're going to organize all of the relevant transactions into two columns, cash inflows and cash outflows, and record the values of each transaction. So our net income, that's coming in from the income statement. It's going to be a positive value unless there's a loss. We're going to add back depreciations from the income statement. Then we categorize all the changes in our working capital accounts, our current assets and liabilities. And remember, same rules apply for our current assets. If there's an increase in the value of an asset, it's going to be a cash outflow, a negative number. If there's a decrease in a current asset account, it's a cash inflow, a positive number, things like selling inventory. Okay, for our current liabilities, if there's an increase in the value, that means it's a cash inflow. If there's a decrease, it's a cash outflow, a negative number. The next step is once we've processed all the transactions as being included or excluded, we're then going to sum up all of the total cash inflows and then all the total cash outflows. So we're going to have a total number for all the positive values, a total number for all the negative values. Then we calculate the cash flow from operations. We take all of the total cash inflows and then add the negative value of the total cash outflows. So let's work through an example. So we have a firm that's reported the following financial information, and we want to find out what is the cash flow from operations. So our first step, write out the formula. So we have our formula here, net income plus depreciation expenses plus or minus changes in working capital accounts excluding cash, and then adding back anything else that should be. So the first thing we do is identify what accounts are relevant. So we know net income is relevant. Depreciation is relevant. Accounts receivable, that is a current asset. That's relevant. Our inventory, that's a current asset. That's relevant. Accounts payable, that's a current liability. That's relevant. The last two transactions, change in gross PPE, that's not included. That's a long-term asset. That's going to show up in cash flow from investing. And then our change in long-term debt, that's a long-term liability. That's going to show up in the cash flow from financing. So now what we're going to do is organize the transactions into two columns, cash inflows and cash outflows. And then record the value of each of the relative transactions in the correct category. And you'll see we have our net income, that's a cash inflow. Our depreciation, that's a cash inflow. We add it back. And then our change in inventory. Now notice, the change in inventory is a negative number, but its impact on cash, it's a cash inflow. Why? Well, this means we sold $20,000 in inventory. We've generated cash from that transaction. Okay, on the outflow side, okay, our accounts receivable increased by $15,000. What that means is that customers have purchased $15,000 of revenue from us, or generated $15,000 of revenue, but it's been paid for on credit. We have sent our goods and services out the door, but we have not received the cash for it yet. So anything that's accounts receivable are sales that have been made on credit that we do not have cash for yet. So that's a decrease in cash because we've taken the goods and services, put them in the hands of the customer, but we don't have the cash yet. Does that make sense? Okay, and then lastly, this change in accounts payable, a negative value. Well, that would be things like my Staples account. If it's a negative transaction, it means I've paid off my bills. So that means cash has gone out the door. So yes, accounts payable is items that we've paid off because it's a negative value. It's a liability we've paid down. Okay, so any questions on the categorization of these transactions? Okay, then our next step, we total up our cash inflows and our cash outflows. So now we clearly see, okay, we've got $1,045,000 in cash inflows, and there was $115,000 in cash outflows, negative value that went out the door. Last step, we're just going to take those cash inflows and add the negative value of the cash outflows, and we get $930,000. That's a net cash inflow for our cash from operations. Cash flow from operations. Any questions on that so far? Okay. So one other thing to talk about is sometimes when we are presented information, We may not get all of the details of the account transactions that happen. We may just get one figure, a net change in working capital. So keep in mind, working capital is current assets minus current liabilities. And so identifying if that net change in working capital is a cash inflow or outflow is critical in our net cash flow from operations calculation. So if we see that net change of working capital shows up as $10,000, a positive value, well, that's going to be considered a cash outflow because it means that our current assets had increased more than our current liabilities. So that means more cash has been tied up in things like inventory or accounts receivable. So it's going to be a cash outflow, a use of cash. On the flip side of that coin, if we see the net change in working capital is negative 10,000, a negative value, it typically means it's a cash inflow because the current liabilities have increased more than the current assets. So that means less cash is tied up. So it means that we've either collected receivables or it could mean that we've increased our accounts payable significantly. We've delayed payments to suppliers. So that negative value, in this case $10,000, is cash that's freed up. So it's a cash inflow. And so here's an example where we just are presented with the change in working capital. And you'll see, in this case, it's a positive number. So it means the current assets have increased more than the current liabilities. So that means it's going to be a cash outflow. Any questions on that if you just see the net change in working capital? Okay, then let's move on to the cash flow from investing activities. So that reflects cash we've used or received from acquiring or disposing of our long-term assets. So it includes things like buying equipment, buying or selling property, purchasing long-term investment instruments like stocks or bonds that we're going to hold for more than a year in a portfolio, or investments in other businesses, like when we acquire patents. So a cash outflow in this section of the cash flow statement typically means a reinvestment in our business. That's what happens when we see cash outflows. Inflows means we've either sold or divested assets. And so this shows us how we've allocated capital to support the firm's future operations and growth. So when we're looking at the balance sheet, our cash flow from investing is only concerned with our long-term and fixed assets. And typically, this total is going to be a negative number. It's typically going to represent cash outflows from acquiring long-term assets. So just like we did with our cash flow from operations, our cash flow from investing is going to follow a similar process. We're going to write out the formula first, which is the cash inflows from investing activities minus the cash outflows. We'll identify all the relevant accounts to include in the calculation. So remember, we're going to examine each transaction and only include it if it's related to a long-term asset account, period. Then we're going to organize the account transactions into two columns, cash inflows, cash outflows, and record the value of each of the relevant transactions. And then going back to our general rules here, these are asset accounts we're dealing with. So if it increases in value, it's a cash outflow. That transaction is going to have a negative value. If it's a decrease, that means there's a cash inflow, like if we sold a land parcel. Well, that's going to be a cash inflow and be a positive number. After we've processed all the transactions, we're then going to get our total cash inflows and then our total cash outflows, which is the negative number. Then to calculate our cash flow from investing, we're going to take our total cash inflows, which is a positive value, and add it to our total cash outflows, which is a negative value. So given these account transactions, we're going to find the cash flow from investing. So let's start processing this. First thing, we're going to write out our formula. Next, we're going to identify only the relevant accounts to include. So in this case, change in gross PPE, 200,000. Okay, that's a long-term asset. Okay, inventory, no, that's a current asset. That's included in our cash flow from operations. Change in our long-term investment portfolio. We said those are things like stocks and bonds that we're going to hold for more than a year as investment instruments to earn returns. So that's included. Change in long-term debt. That's not included. It's a liability. That's going to show up in our cash flow from financing. Remember, we're only concerned with long-term assets in our cash flow from investing. Okay, sale of a land parcel. That's included because that's a long-term asset that we have disposed of. We've sold it. And then our depreciation expenses, no, that is reported in our CFI. And I think I have a typo here. I need to change that. So your depreciation expense is reported in your cash flow from operations. You know what? I'm going to make that correct. You know what? Yeah, let me make that correction quickly so I can resend that to you folks if it's not corrected in what I've sent you. Yep, you know what? We'll keep moving forward, but that correction will be made for you. So let's take a look and organize these account transactions into the two columns, our cash inflows and our cash outflows. So the only cash inflow we're seeing here is the sale of that land parcel. Our cash outflows, however, are going to be our purchase of more PP&E and our change in our long-term investment portfolio. Next step, we're going to total up the inflows and outflows. So we see here, we've got a total of 50,000 in our inflows, a total of 300,000 in our outflows. So we add them together and our cash flow from investing is a net cash outflow of $250,000 because typically these are long-term assets. It represents reinvestment in the company. So it's often going to be a very large negative value. Any questions on that? Okay, so let's talk about the last section of the cash flow statement, financing activities. So those are cash transactions where we're raising capital to fund our growth in the firm. And we deal with lenders and shareholders. And so some forms of inflows are going to be issuing new bonds or getting new loans from the bank that are greater than 1 year. We might issue common or preferred stock. That's raising capital through equity. Some outflows would be repaying our debt principal, meaning we have a series of bonds that matures in value. Well, guess what? We've got to make that balloon payment out to our bondholders for the face value of those bonds. It's a cash outflow. Then paying out our cash dividends to shareholders. That's included, and it's always going to be a negative value, a cash outflow. And then there's going to be times where a firm might want to repurchase its stock. And that would occur if a firm wants to take back more ownership control of the firm. There might be investors that they don't want to be able to take over the firm, so they'll put out a call to see if investors want to sell their shares back to the company so they can make sure they have at least 51% of the total stock that's outstanding. So that would be a big cash outflow. And this section of the cash flow statement reflects how the firm raises its capital and returns value to its investors. So going back to our links to the balance sheet, well, our cash flow from financing is only concerned with our long-term liabilities and our equity accounts. Let's see. As I mentioned, there was a question about the change in gross PPE. That was a typo error. Basically, when the slideshow was being created, some copying and pasting was probably done. That one has to be created, so it will be corrected and sent back to you. That makes sense? Can I get a response there? Okay. Yeah, that's a typo on the slide. It wasn't related to PP&E. It should have said depreciation expenses, so that will be corrected and an update will be sent to you. Okay, so talking about our cash flow from financing here. So it only involves long-term liabilities and equity accounts on the balance sheet, just this lower right-hand section. Okay, so we're going to be taking any changes to these accounts, and we're also going to subtract out our dividend payments. Now, this number that results is typically a positive number unless the firm has made a large repayment of debt or has repurchased a large number of shares of stock. So this calculation process is going to follow the same pattern as the other two. First thing we're going to do is write out the formula. Then we're going to identify all of the relevant accounts to include in the calculation. So we're only going to look at long-term liabilities and equity, okay? So it's not going to include any of our, excuse me, short-term liability or current liabilities. The other thing we're going to have to look at is our dividend payments. Now, if we're given our net income, there typically is going to be a dividend payout ratio if we're not provided the dividend payments directly. So there's one of two ways we can arrive at the dividend payments if they're not presented directly. Typically, we're going to see a net income and a payout ratio, or we may be provided with the net income and the additions to retained earnings. And I see that there's some updates I need to make to this slide too. So I'll be issuing you an update here because this should say long-term liability and equity accounts. Okay, so noted, and I'll get that sent out to you. So then we're going to take our transactions and organize them into the two columns, cash inflows and cash outflows. So we're going to categorize all of our changes in our long-term liability and equity accounts, okay? And there's a direct relationship. So if it increases in value, it's a cash inflow. Things like issuing bonds. That means we've raised money from the issuance of bonds. Issued common stock. If there's a decrease in the value, that's going to be a cash outflow. It's going to be a negative number. And then our dividend payments are always going to be cash outflows, a negative number. And again, we'll follow the process of totaling up all the cash inflows, totaling up all the cash outflows, which is going to be a negative value. Then we're going to calculate our cash flow from financing by totaling up the cash inflows and the cash outflows as negative values. So here is a worked example. Here's our list of account balance changes. And then we're going to find out what is the cash flow from financing. So something to note here. We don't have our dividend payments presented correctly, but we're given our net income and our dividend payout ratio. So first thing we're going to do is write out the formula for our cash flow from financing. Then we're going to identify all the relevant accounts. So the dividend payment is not listed, but it's going to be based on the net income presented and the dividend payout ratio. So let's walk through. Our changes in account payable, that's not included. That goes into our cash flow from operations. We've issued stock. Yes, that's included. We've raised more capital through equity financing. Okay. Change in long-term investment portfolio. No, that's going to be a cash flow from investing on the asset side of the balance sheet. Now, bank loan repayments of $50,000. Yes, we're paying down a liability. And then increase in bonds payable, $1 million. Okay, we're raising more capital through issuing more debt. So the last item we have to consider is our dividend payments. We're not given those directly, but we know if we take our net income times our dividend payout ratio, that tells us what percentage of net income is paid out to our shareholders. And in this case, it's 40%. So we take the $200,000 of net income times 40% gives us dividend payouts of $80,000. Does that make sense so far? Okay, so then our next step. Let's organize all of the transactions in our changes in long-term liability and equity accounts, and then categorize our cash inflows as positive numbers, our cash outflows as negative numbers. So our stock issuance, yes, we're going to have a cash inflow because we're increasing the amount of cash we've generated from investors. Our bank loan repayments, again, that's a payment going out the door to the bank. It's a negative number, a cash outflow. Increase in bonds payable, that's a cash inflow. We've received more money from investors in the form of selling the bonds. Then our dividend payments, that goes out the door to our equity shareholders. That's a cash outflow. So we total up all the cash inflows and all the cash outflows. And then lastly, we take our cash inflows plus the negative value of the cash outflows. We get our total cash flow from financing, $945,000, and that's a net cash inflow. We have raised more money through external financing than we have paid out in the form of loan payments and dividends. Does that make sense to everybody? Okay, so now that we have all three sections of our cash flow statement calculated, we perform the cash flow reconciliation, which is taking the beginning cash balance, adding the total net cash flow to it to get our ending cash balance. And then our net cash flow is acquired by taking the three totals from the three sections of the cash flow statement and adding them up. And so if you want to detail it out, it's our beginning cash plus or minus our cash flow from operations, plus or minus our cash flow from investing, plus or minus our cash flow from financing. That gives us our ending cash. And this is going to explain how our cash and cash equivalents have increased or decreased for a reporting period. And reporting it this way makes it transparent as to how the cash was generated and used. So using the three values we acquired from our samples, let's assume our starting cash balance is $1 million. Well, we're going to take our three totals, our cash flow from operations, our cash flow from investing, and our cash flow from financing. We're going to total those up. That gives us our net cash flow. In this case, it's $1,625,000. So to calculate our ending cash, we take our beginning cash balance, which we said to assume is $1 million. We add that net cash flow because it's a positive number, and then we get our ending cash balance of $2,625,000. Does that make sense to everyone? Okay. So if the calculations make sense, the next thing to talk about is analyzing the cash flow statement. And so analyzing cash flow statements is a regular activity that finance professionals perform. And when we do that activity, we're looking at every line of the cash flow statement to determine if the activity looks appropriate and if it is a good, and if we are seeing reliable information. We're also looking to see is too much cash being generated from accrual activities, which means that the firm really doesn't have the amount of cash it truly needs to fund its day-to-day operations. So when you're performing this cash flow statement analysis, you typically start with a list of standard questions that are based on the firm's business model, and then you add more as you learn the details. But having a good set of standard questions helps you develop a baseline analysis. Now, I'm not going to go over all these questions in detail, but When we analyze the cash flow statement, it helps us show the firm's economic characteristics. It helps us kind of identify what stage of the life cycle the business is in. Because we mentioned startups. Well, they're kind of going in the reverse direction. They're not typically generating most of their cash from operations. It's typically mostly from financing. And then they're investing in the firm, and then they typically do not show a profit for a while. So understanding what's happening in the different sections of the cash flow statement can kind of give us a bead on where in their life cycle they are. Okay, looking at that cash flow statement also helps us understand the links between the income statement and the balance sheet, meaning where is the cash coming from? Is it coming primarily through operations, or are we having to get it primarily through financing activity? Okay, and the reason we want to look at both of these things is because just because a firm has a good looking income statement, it could mean that they still have far more cash requirements that aren't showing up. And so this may erode the cash they need to do things like service debt, or if they have to pay out a large amount of dividends to shareholders that they weren't expecting. And so another thing that might come up is that even though our cash flows are healthy, it may not be that the firm is healthy. And so we have to take a look at, so for example, if we see a lot of activity in our cash flow from investing that's generating cash flow from the divesting of assets, that's a red flag that something else is happening with the company. And then we talked about the accruals. So accruals are things like accounts receivable, accounts payable. So we want to make sure that those are not hyperactivities, meaning they're not reflecting a large percentage of our actual cash generation. Okay, so here is a list of some sample questions one might want to ask as you're analyzing the cash flow from operations. And like I said, I'm not going to go into these in detail. These really aren't covered by the text, but as finance professionals, these are things you should start to consider as you perform your analysis on cash flow statements, is having a good set of questions that, okay, here's how I look at a cash flow from operations to start with. Here's how I look at the cash flow from investing to start with. You know, we're taking a look at the types of assets the firm is investing in. You know, are they accumulating goodwill and sustaining value? Okay. Another thing that's important to look at is a firm often will budget the acquisition of assets, but have those assets been acquired yet? Because if they have, we should start to see the depreciation schedules become active, which is going to impact our cash flow from operations. So if we see a disparity there in our cash flow from operations, the first thing to say is, okay, we should be seeing larger depreciation because we're supposed to acquire new assets. Well, have those assets been acquired yet? And so, again, these are just some baseline questions you can start asking. And the same thing here applies to our cash flow from financing. So a big thing to consider, especially when we have publicly traded companies, is, you know, it's okay to use debt because debt is a cheaper cost of capital than equity. We just want to make sure that we're not overusing debt so we're not placing the firm in risk of bankruptcy. Okay? And is the firm using externally raised funds appropriately? Meaning, net income is typically how we like to fund our growth. But if we can't afford to just through net income, if we don't use some kind of external funding, we may be missing out on growth opportunities. So it's always a good idea to take a look at that. And I put this checkpoint at the bottom. One thing you have to consider when you're looking at the cash flow from financing section is that privately held companies will not have cash flow from generating shares of stock. It's primarily going to come from debt and income-based equity funding. Remember, only about 1% of firms in the U.S. are publicly traded. So most firms are going to rely on their net income, their equity generated from net income, and debt as their cash flow from financing. Any questions on that so far? And again, this isn't really stuff you're going to be tested on, but I wanted to give you this information because you're finance majors. And so I think you'll find it useful as you're working through the course and working through your other courses. The next thing I have for you, and we won't go into this in detail, but because it's in the slideshow, you'll have them to consider. And based on our cash flow statement, here is a list of reflective review questions you should ask yourself to make sure you have the sufficient level of knowledge of the cash flow statement, its structure, and its calculation so that you are prepared for the OA. And you can review these as you're working through the materials. And so to summarize what we've reviewed in the session, so the cash flow statement shows us how the firm generates and uses cash, and it complements the income statement to show us how the firm is, focusing on its liquidity and how cash is actually moving through the organization. We divide the cash flow statement into three sections: the cash flow from operations, which are generated from core business activities; cash flow from investing, which is coming from our purchase and sale of assets; and cash flow from financing, which is our debt and equity transactions. We reviewed a calculation method for the cash flow statement sections. We're using the cash inflow, cash outflow method. This allows us to compute net cash flows for each section. Another important consideration is our balance sheet links and how they impact cash. And we talked about our relationships between changes in asset, liability, and equity accounts and how they impact cash. Okay, we talked about some of the benefits of analyzing the cash flow statement. And so it's really an important process to get into the inner dealings of the firm to truly determine its financial health and where it might be in its company life cycle. And then from a professional perspective, when you are out in the world as a financial analyst, you're typically going to be looking at that cash flow statement line by line and using targeted questions to assess how efficient the firm is in its operational strategies, its investment strategies, and its capital structure. Okay, so with this in mind, let's do some review questions. Okay, so the first question: what is the primary purpose of the statement of cash flows? And you can just type your response there in the chat if you want. You don't have to. Let's see, consensus says C, and that is the correct answer. Cash flow statement explains how a firm generates and uses cash through its activities. Okay, a decrease in inventory is treated as what here? Which one of these is the best descriptor? And consensus is A, and that is correct, because a decrease in inventory means we have sold inventory to our customer base, and that frees up cash, making it a cash inflow. Okay, which of the following is not included in our cash flow from operations? Okay, consensus is C, and that is the correct answer. That's part of our cash flow from investing, not cash flow from operations. Okay, which of these items is going to get excluded from our cash flow from investing calculation? Okay, and again, that is going to be C because inventory is a current asset and it's part of our cash flow from operations. Okay, so what is our formula for calculating our cash flow from operations? Okay, consensus is B, and that is the correct answer because we're using the indirect method. Okay, and so which of the following statements is true about the indirect method of reporting cash flow? And B is correct. And so we're adjusting it for non-cash flow items like depreciation. Okay, and which is considered a cash inflow under investing activities? Okay, and consensus is B, and that is correct. We sell the land, it creates a cash inflow for us in our cash flow from investing. Okay, so which of these formulas represents our cash flow reconciliation? And the answer is B. We start with our beginning cash balance, and then we get our net cash flow from the three sections of the cash flow statement, add them together, and get our ending cash. Okay, which of these activities typically results in a negative cash flow? Okay, and that is going to be the purchase of an intangible asset because it's going to take cash to perform that transaction. And it's going to show up as a cash outflow under our cash flow from investing. Oops, well, I already answered that one for you. What does an increase in liabilities typically represent? And that's going to be a cash inflow. Okay. Which section of the cash flow statement reflects how a firm raises capital? And the answer is C. It shows us how we're raising capital through either debt or equity transactions. Let's see here. I do have a worked example. We're running out of time here, but what I have here is a worked example showing you three sections of the cash flow statement and working through each section. So if you want to take a look at that, it will definitely be helpful for you. And again, I have a few slide corrections to make. And so once I correct those slides, I'll send that out to you along with the video. As far as the video goes, it may take a day or so to process because we have to make sure all the captions in there are accurate, and that takes a while. Do we have any other questions before we conclude the session? Okay, well, if you have any questions, make sure you're taking a look at your course community for the class. I post things there regularly if you've not been keeping up with it. Typically, I'm posting every time we have a new resource, or if we have a new session or any other kind of tip. So do take a look at the discussion thread in the course community regularly. I always post announcements when I am going to do a live session, or Dr. San Pietro is going to do a live session. So take a look there. Let's see. Yeah, and so as far as what we post there, so notice whenever a video has been posted, I let you know. So for example, here's a new one about new cohort materials. There's a video there. When we have a new session video, we tell you. So this is where you'll want to check to let you know that I've got the video for this session updated and out on the course resource page. Also, make sure you're taking a look at the course resource page under the lesson review cohort section. This is where all the links are for all of our resources that we generate with videos and slideshows. And make sure that as you have questions, your course instructors are going to be your best source of information. Course instructor calls are the most efficient and effective way to get your specific content questions addressed and get individualized attention. If you use the team instructor link, that will get you to the first instructor that's available because it consolidates all of our schedules in one place. Make sure you're keeping up with, as we have new live events, there's going to be another one, I believe, in 2 weeks. And so just make sure you're taking a look at the discussion thread. I also typically send an email to everybody to let you know what the agenda is going to be for that session. So take a look for that. And then you can always send an email to your assigned instructor or to the team box if you have a onesie-twosie question you need addressed. Okay. So we thank you for your participation today. I appreciate everybody's attention and engagement in the session. And we'll get you that updated slideshow and the link to the video when that's ready. And hope you all have a great rest of your day and week.